Thank you very much. It's obviously an honor to be here. As Jim said this morning, on the one hand, it's a sad event, but on the other hand, this is exactly what Gary would have liked, as a tribute, his colleagues and friends talking about ideas, and ideas inspired by Gary. So I think we should be very grateful to the organizer for putting together this program. This is joint work with Monica Costas-Diaz and Costas Meguia. One of the basic motivations of this paper is the fact that we all learned a lot from Gary, but we think we still have a lot to learn from Gary. There are plenty of intuitions that we can find in Gary's papers, and if we put them together and try to dig a little bit deeper and to push them, there are plenty of things to be found. And so let me start with two fundamental insights. One is the notion of human capital, and I'm not going to talk about this because Scott did it in his, at the beginning of his paper, but this notion that human capital is an investment and should be thought of as an investment. And the other set of ideas that we will be referring to in the paper is the notion of matching, and matching as an equilibrium phenomenon. So I reread recently the 73 papers in the JP, which are a theory of the marriage market. And what's very striking is that the introduction of the paper, Gary says, marriage is a phenomenon which is crucially important, and economists are not talking about this. So either it's a major weakness of economic analysis that we're not able to talk about this, or it has been neglected, and that's something that we should correct. And of course, he was going in the second direction, and we know now that it turned out to be incredibly fruitful. Now there are two kind of deep ideas that we took from Gary's analysis of matching model. The first thing is who matches with whom, who marries whom, is very important. It's something we should think about in economic terms. And actually, if we think if we use the right economic framework in terms of surplus and so on, there is a lot that we can learn about this. And the second insight, which I think is even more important, is this notion that what the matching model tells you is not only who's going to match with whom, but also how will the surplus be distributed. And I will try to convince you that if we want to think in terms of human capital accumulation, this is something that we should not neglect. So if you think of those two basic notions, human capital on the one hand and matching on the other hand, a very natural question is, do we expect assortative matching on human capital? And if you look at this, it's far from obvious. So if you take the simplest model in which people consume private and public good, and everything is purchased on the market, if you put transferable utility, which is the kind of framework that Gary was mostly referring to, this buys you as positive assortative matching quite easily. If you introduce, however, domestic production, so if some of the public good, instead of being purchased off the market, are produced within the household, then you have a problem. And the problem you have, which is explicitly stated in Gary's 73 paper, is that the kind of matching you would expect is that highly educated women should marry low-educated men, and the men should specialize into domestic production, which is definitely not what we have in the data. Now, the answer to that could be that maybe human capital is important not only for your market work, but also for domestic production. Now, and actually in the companion paper with the same two co-authors, we tried to go in this direction and try to see what exactly do you need to assume on the production function to get assortative matching in this context. But that's not what I'm going to talk about today. Today I'm going to talk about the standard impact of human capital, which is the impact on wages and careers. But we're going to put some risk. So in the sense, from a structural point of view, the model we have will be a standard model in which your wage at any moment is determined by your level of human capital, and then there are shocks, and some of those shocks are purely transitory, but some are permanent. So you can think of those shocks as having an impact on your level of human capital. Now let's try to think about assortative matching in a context like this. The first remark is that if you are in this kind of models, typically the shocks have a multiplicative impact, which means that if you have a high level of human capital, your expected wage is very high, but also the volatility of your wage is going to be very high. Now assume that I have a high level of human capital, which means that I have a lot of what could be called background risk. I have a high expected wage, but this wage is going to fluctuate a lot. Is it so clear that I want to marry an educated woman who also has a high level of expected wage, but also has a lot of riskiness? Now, here we need to be very precise, because the question is more complex than it sounds. The question is not, is it better to marry an educated woman despite the fact that this higher education comes with higher volatility? The answer to this question is always yes in this kind of problem. And what we learned from Gary, and in particular from the 73 paper, is this is not what assortative matching is about. Assortative matching is not about the surplus being increasing, it's about the surplus being supermodular. Sorry for the jargon, but what it means is the following. The question is not, do I prefer being myself highly educated? Do I prefer a highly educated wife despite the fact that it comes with a lot of volatility? The answer to that is yes. But the true question is, my preference for a highly educated woman, is it stronger than the preference of someone who would have less human capital than me? And that's definitely not obvious. So that's the kind of question we want to think about, and we want to think about those questions in an explicit theory-based model. It's research in progress. Now, this is a kind of short presentation of what we're doing from a Beckerian perspective. Before entering the detail of the model, let me give you two alternative presentation of what we're trying to do. One will be a kind of labor supply perspective, and the third one will be an empirical matching perspective. So from a labor supply perspective, there's been a huge literature on labor supply models, and many people in this room actually have contributed to it. You can use different types of model. You can be unitary, you can be collective, you can look at the joint determination of both labor supply, or just look at the labor supply decision of the wife conditional on the husband, and so on and so forth. But if you look at those models, they have something in common, namely that they take human capital as exogenous. So people enter the labor market with some stock of human capital, and they also enter the labor market with a spouse, and this also is taken as exogenous. And what we want to do in this kind of paper is we want to explicitly recognize the endogeneity of both the premarital human capital investment and the choice of a spouse. And those two are related. Actually, in a different paper with Murat Yegun and Yoram Weiss, we emphasize the fact that you should not think of investment in human capital independently on marital decision, if only because one of the main return that you get from your human capital investment are changes in your prospects on the marriage market. Now, why is it important? Because one of the things I personally learned from Gary, and I had the privilege of interacting a lot with him and discussing a lot with him, is that we should always think in terms of not only short-term but also long-term consequences. So think of a reform that directly affects the return to human capital, like taxation, for instance, or things like this. The short-term, if you want to assess the short-term effect, you're going to look at the impact on labor supply of existing couples. But in the long run, that might affect investment in human capital, that might affect marital patterns, who marries whom, and actually those two components might interact. And that's exactly what we want to look at in this kind of model. And now, I apologize, this one is a bit more technical, but there has been a huge literature on matching models. Now, Scott was alluding to the theory part, which has been moving a lot, but there is also, there's been a lot of advances on the empirical part. This will be matching with transfers, and essentially for today is going to be a transferable utility framework. So we do now, there are a few standard empirical approaches, and the one I will be referring to now is the one that was introduced by Eugene Chu and Aloysius Sayo. And I have a paper with Bernard Salani and Yoram Weiss in which we go in the same direction. So essentially, you want to take a matching model to data. The first thing you have to account for is the fact that matching models tend to give you very simplistic prediction. like, assortative matching, the men with highest level of human capital should marry the women with the highest level of human capital. And that's not what we see in the data. We see positive correlation, but we don't see a correlation equal to 1. So and that's not surprising. People match on a bunch of dimensions. Some of them we do observe, some of them we don't observe. So the natural way as economists to capture this is to put some kind of stochastic structure. Now the paper, the fundamental innovation in the paper by Eugene and Aloysius was to introduce a very specific stochastic structure that allows you, that makes things tractable, and that's exactly what we're going to use here in this paper. However, in those existing works, the identification is only for matching patterns. So you try to identify the economics of the situation using exclusively who marries whom. And in a sense, that's not much. So the kind of curse of this kind of literature, and I think it's an extremely valuable literature, and I've been working a lot in this direction, but there is only so much that you can identify from this kind of structure. In general, you will have a highly parametric structural model, and in addition, it's very hard to generate over-identifying restrictions. But here, things are different, because we do observe matching patterns, but we also observe behavior. We observe labor supply. So the basic idea of this model is if you want to be a little bit more explicit about behavior, and you want to be explicit about the kind of model, what people do, what people maximize, or how people behave, from the observation of behavior, you can recover a lot of information. Actually, you can recover information on preferences. That's completely standard. That's labor supply, but preferences, if your model is well written, tells you exactly what the total surplus is, which means that we're estimating matching models in which not only we know who matches with whom, but we also have additional information on the size of the surplus. And this completely changes the nature of the game. And in a sense, the reference here would be a natural reference would be a hedonic model. We have known for some time that from a theoretical point of view, there is an exact equivalence between matching models under transferable utility and hedonic model under quasi-linearity from a theoretical point of view. From an applied perspective, things are completely different because in a hedonic model, you observe much more. You observe who marries whom or who's matched with whom, but you also observe a price. And there is a lot of information in the price because the price tells you things about transfers. Well, it is pretty much the same. You don't observe the price, you observe the total surplus, but that goes in exactly the same direction. Okay, that's for the general motivation. Let me just very briefly describe what the basic framework looks like. So pretty much like in Scott's paper, agents will invest in education before entering the matching game. The human capital follows the usual dynamics. So there is, you start with a level of education, and then there are shocks. Some are transitory, some are permanent. At any moment, your wage is your human capital plus the shocks, and the shocks are multiplicative. We assume efficiency, so we assume efficient resharing within a household, and we assume efficient labor supply conditional on the realization of the shocks. The model is pretty simple. There is leisure, one private and one public good, and we keep the transferable utility context. This is very Beckerian. It helps a lot because in a TU model, there is a complete divorce between efficiency and allocation. Efficiency, if you just use efficiency, it tells you a lot about behavior. And then you can concentrate on the allocation just looking at the matching part of the model. This will be, I realize this is a bit vague, but hopefully it will be a bit more precise in a minute. Okay, so let me be precise about the timing. One, agents invest in education. When they invest in education, they don't know who the spouse would be. So that's completely non-cooperative. Different people have different cost of education, meaning that they will not invest at the same level. Matching models are about heterogeneity, right? So this will be an heterogeneous model. Then agents enter the marriage market with their education level. Matching takes place based on the education level. And we assume full commitment, although this could be relaxed. And then we have real life, we have labor supply, except that we don't want to collapse all this in one period. So the third phase will be divided into a bunch of sub-period. And at each sub-period, The shocks are realized, and it's the usual multiplicative structure. So your wage is a global shock affecting everyone. You'll multiply by your level of human capital, multiply by a shock, which has a permanent and a transitory component. Then agents supply labor and consume. As I said, they could be permanent or transitory. Now, you want to solve a model like this, you start from the end. So you start with period 3. One of the main advantages of the transferable utility framework is now there is something like a household utility, because under transferable utility, what people do is they maximize the sum of utilities, so you can treat the household as if there was a single decision maker, and you can apply exactly the technology of dynamic labor supply model that have been developed over the last 20 or 30 years. And what this will give you is the expected surplus at the household level. So it will tell you everything about the total size of the pie that those people are going to share. And it tells you exactly nothing about the way the pie is shared between the people. So that's stage 2 now. Stage 3, sorry, now let's move to stage 2. We know what the matching game is about, because we know exactly the size of the pie people would have to share should they choose to match together. So the equilibrium condition will tell me first who marries whom by education, and second, the intra-household allocation. So in particular, I will know exactly what benefits I would receive from entering the marriage market with a given level of education. I could counterfactually compute the benefit that I would have received with a different level of education, which means that these models tells me the return to education. And then at stage 1, I can model the decision of education using the kind of benefit that have been determined at this level. Okay, a few technicalities. There is no way I would have presented this paper in front of Gary without writing the utility function. So I'm sorry, but if Gary was here, he would like to see the utility function. Here is the utility function. It's Cobb-Douglas regarding private and public consumption, and then there is the utility of leisure of the disutility of labor, which has a sort of standard form. In principle, so the coefficient will be different across genders, and in the empirical implementation, we could even allow for an observed heterogeneity across individuals. That's just a numerical issue. Now, from a technical point of view, if you look at this ordinal utility, it belongs to a class which is called the general quasi-linear class, and this gives you transferable utility in the ordinal sense. In addition, if you look at the risk attitude, everybody has a log utility, and this belongs to the Ishara class. Now, the notion of Ishara was introduced by Maurizio Mazzocco, who was a student here at Chicago, and the fact that this is sufficient to give you transferable utility was proved by Sam Schulhoff-Wolf, who was also a student here at Chicago, and both results are part of their dissertation at Chicago. So that's a kind of Chicago tradition. So we have a standard transferable utility model. Labor supply, we can look at the intensive and the extensive margin. So it's a kind of, there is a Euler equation that you can solve numerically. So here is the only thing that, and actually the specifics are not that important, but what this is telling you is the following. If I use the right representation of each person's utility, so what I'm going to use to represent the utility of person I happens to be the exponential of the expected utility defined like this. That's the way you have to do it. That's a technicality. But you have this nice structure that this representation of utility for member 1 plus the representation of utility for member 2 is equal to this animal here, which is something not very nice, but which is something that you can compute always numerically. Sometimes you have a closed form, not here, but you can always compute it numerically. So it's exactly what I said before. We're going to look at a transferable utility model. This tells you there is transferable utility, but in addition, the size of the surplus, we can recover it from standard labor supply analysis. Let me keep supermodularity. Well, in principle, if we want to go back to the question I asked at the beginning, do we have supermodularity? Is it the case that in a model like this, high human capital people marry high human capital people? Well, that's another thing we learned from Gary. We just need to look at the properties of this function here. Essentially, we need to look at the sign of the second cross derivative. Now, in practice, it's easier said than done, but you can always compute numerically. And so one of the issues here will be, what do we get in reality? By the way, things are going to be a bit more complex because this is a deterministic version, and of course I need to put a stochastic structure. So let's move to that. Let me just, before that, give you some, this is very preliminary. It's not even estimation. It's calibration. It's something that I received yesterday from my co-author. But just to give you an idea that those things make sense. So you can estimate the wage equation, which is a standard one. This is the distribution of education. So we're using a British household. We're looking at them in 91, and then we're following them. We're just looking at one cohort. But we're following them for 17 years, so that we do have a kind of a dynamic dimension in the labor supply equation that we're estimating. So this is still a time when men were more educated than women. Of course, now it would be just the opposite, as you know. But so it's interesting, you know, those are relics of the past. Now, this is the kind of preference parameter that we get. They're not very interesting, except that it's something like the wage elasticity of labor supply for men is about 0.1, and for women it's about 0.5. So it's not, you know, it's not, there is nothing crazy. And this is the surplus, right? This is the kind of exponential of the integral kind of very weird stuff that we had. But those are numbers. Now, if you look at this is supermodular. The way you see that it's supermodular is take any 2x2 submatrix, look at the sum on the diagonal, and subtract the sum of diagonal, you get something positive. This tells you that they're going to be. Now, what's interesting is, as we're going to see, a prediction of this is we should see some assortative matching in the data. And we know that there is. But this, we recovered that without even looking at matching patterns. It's only from labor supply. So there is, you can think of it as something like a consistency. If we were to find something that grossly submodular, then we would be in trouble because it would contradict what we observe on the other dimension. Well, here it's not the case. Those are the empirical matching patterns. As I said, you see a lot of assortative matching. For instance, which you see in particular by the fact that there is many more people on the diagonal than you would expect with random matching. In particular, if you look at this number here, the educated men are only 12% of the population, but they are almost 40% of the husbands of educated women. So you got a lot of assortative matching in reality. Okay. Now, let me talk a little bit about the econometric structure. That's exactly the one introduced in Chu and Sayo. So there's some levels of education, some classes of education. In practice, we're going to use 3 of them in the UK data. In the US, we were using 5 of them. People have preferences, idiosyncratic. Now, remember, what I want to explain is the fact that we have the surplus is supermodular, but we don't see that each and every educated man marries an educated woman. So which means that there is some kind of heterogeneity in taste. There are dimensions on which people match that we don't observe. So the way we do that is to say, look, when you're born, or actually at some point in your life, you receive preferences. And those preferences are about, first of all, being single as opposed to being married. This is in this kind of model with public good, it's always better to be married, but you might have preferences that reflect in the fact that you remain single. And you might have also preferences about marrying someone who's educated versus someone who's less educated. Like, you know, if the greatest thing in life for you is to go to the opera and listen to Berg, then presumably it's better if you marry a highly educated wife. If the best thing is going hiking in the country, it's probably less important. This kind of stuff. You know, there are some kind of idiosyncratic preferences. So this is exactly what's captured by those things here. You need some kind of separability, and I will not insist on this, but this is completely crucial. In which sense do we have assortative matching in this world of randomness? Well, we have a result by Graham in 2 papers, 2011-13, which tells you the following. Take 2 education category, for instance, high school and university, and take all couples in which both the husband and the wife have those levels of education. If the deterministic part, the S here, is supermodular, which we get in our data, then what you predict is that among those couples, the number of people on the diagonal should be more than what you would expect under random matching, and the number of people off diagonal should be less than under matching. It's not much, but that's the only thing that you can establish in full generality. What's interesting is you just need supermodularity to do that. There is an alternative way of introducing randomness in this kind of model, which will be to put search friction, which has been done in particular in a very influential paper by Rob Scheimer and Smith. But then the conditions to get assortative matching are different. You need a bit more than supermodularity. You need log supermodularity. So in other words, there are various ways of introducing frictions in this kind of models, either frictions or unobserved heterogeneity. We don't exactly understand the relationship between those different directions, but at least here that's what we have. Now, this is the main result that motivates everything else. At the end of the day, so remember, this guy here is the total size of the pie if person I marries person J. They may or may not marry. I mean, they are very likely not to marry if you take two person randomly, but whether they marry or not and how the surplus will be distributed depends only on this, that's the beauty of those matching models, right? Now, the theorem tells you their functions, V1 and V2. Think of this as this is what Mrs. I would receive. So take Mrs. I was an education HI. Mr. J has an education HJ. If Mrs. I was to marry Mr. J, there is some deterministic component on what she will receive, and there is a deterministic component on what he would receive at equilibrium, which is such that her utility is this deterministic component plus the random shock that's here, and the utility here is the deterministic component plus his random shock. This looks like, not much. Actually, it's a very deep result because if you think of it from a mathematical point of view, those matching models, they are models entailing linear programming. Those variables, if you think in terms of mathematics, you think of them as the dual variables of the linear programming model. And then the question is, if I put some stochastic structure on the primal model, what do I expect? What kind of stochastic structure do I expect on the dual variables? From a mathematical point of view, this is an answer we don't know. This is a question that we don't know how to answer, except in this particular case. So it's a kind of, and again, that's the beauty of the true-SCIO approach, that you got this for free. Now, in the true-SCIO context, essentially, see, if you look at this equation, what this is telling you is this is what my utility will be. So assume that I'm Mr. J. I'm belonging to class HJ. This is what my utility would be if I marry a woman in class at some given level of education. Now, what choice am I going to make? Rational choice. I'm going to choose a spouse such that this element here is maximized. And the same, of course, on the other side of the market, which means that this matching problem, which in principle is a very complex one, boils down to a series of discrete choice models on each side of the market. I can model the behavior of women, and I can model the behavior of men just using the equilibrium condition, forgetting about the two-sided nature of the market. And that's the reason why it suddenly becomes tractable. There are problems with this. So essentially, it's sort of easy to implement, by the way. That's a multi-logit. Assume that those alpha are extreme value distributed. This is a multi-logit. So for each level of education of each woman, you run a multi-logit on the education of the spouse, including no spouse at all. You do the same for men, and you got a bunch of regressions, which gives you those thresholds. So those thresholds are identified. The main problem with this is, of course, they are exactly identified. In other words, first of all, this is a kind of very crude structure. In particular, I'm not allowing for any kind of heteroscedasticity in those terms here, but I cannot. If I do that, the model is under-identified. And even there, with this crude setting, since the model is exactly identified, I don't have any kind of over-identifying restriction. Everything that I observe is compatible with my theory. And that's not good. I want to be able to test my theories. One thing that we learned from Gary is that you should take the model to the data, but you should not have a model such that whatever the data tell you, the model agrees. That's not a very good model. Well, but in our case, now there are ways out of this. For instance, if you consider several cohorts, you can relax that. But in our case, it's not the same because we have some restrictions. We have those restrictions, and those restrictions simply tells us that we know the sum of those coefficients. So in a sense, we have a bunch of multilogit, but we have a bunch of restriction across the multilogit. That's definitely not the way we're going to estimate the model, but this tells you that there is a lot more structure, which means that in principle, our estimation could be much more robust. Let's try. Once we do that, again, we are working on the empirical implementation. It's going to take time, but assume that we can do that and we can have a model like this. What kind of policy simulation can we use? Well, again, coming back to my example, think of a change in taxation, any kind of change that would affect wage dynamics. We can look at the short-term impact. Couples are given, human capital are given. We can look at labor supply. We can look at consumption. In particular, we can look at public consumption. The kind of public consumption you have in mind is essentially expenditures on children. And so that's, it's quite important to realize that if you change taxation, it will have an impact on the amount spent by parents on their children. But all this is taken, the stock of human capital and the matching pattern that's given. But here we can go one step further. We can endogenize matching, so we can look at the endogenous part. And just to give you an intuition of what we're looking at, assume that you take a society in which there are huge differences in economic status across people. And then so people always match on different aspects, the economic aspect and the non-economic aspect, which are summarized by your alpha here, and we're very reduced from there. But the question is, what the respective importance of the economic and the non-economic aspects in the final outcome? And intuitively, if there is a lot of heterogeneity on the economic side, you would expect this to matter a lot. On the other hand, if everybody is pretty much the same on the economic side, then you would expect the non-economic aspects to matter much more. So this means that, for instance, in a more equalitarian society, you might expect matching to be driven less by levels of human capital or wage and more by everything else that we don't observe, but we capture by the variance of these stochastic terms. So in principle, this is testable. And not only we can test that, but we can estimate a structural model and do simulation. And actually, if we want to do the long term, then we can move back to the decision to acquire an education and look at this. Now, this is my last two slides are about what we really would dream of doing, and actually it might work. What we have is a three-stage model. So I've been talking so far the second stage in which you match, taken your level of human capital as given. Now let's talk about the first stage and the interaction between your choice of a level of human capital. Now, of course, all this is under rational expectations, right? In other words, I have to make an educational choice. I don't know whom I'm going to marry. But if I'm able to sort of guess what the situation on the marriage market will be 5, 10 years from now when I'm going to enter the market, and in particular, how many educated men, how many educated women there will be, and so on and so forth, well, if I can guess what the parameters of this model here, I can guess what will be the return to my educations, right? Guessing the return will induce me to make a particular choice depending on my idiosyncratic cost. What do I call an equilibrium is a fixed point. It's a distribution such that if this is the distribution that I have in mind, then the kind of investment decision that will be driven by this distribution will exactly realize this distribution. This sounds bad because we have a fixed point in the distribution space. By the way, my co-author are afraid of nothing, so they told me, the distribution space is finite dimensional. We can do that numerically. And that's one way of doing. Yes, it's a finite dimensional vector, fixed point numerically estimated. But there is another way. And the other way is directly related to what Scott presented, which is, the timing of our two presentations is extremely fortunate. Forget about the true game. So the true game is one in which I first invest and then I enter the marriage market. Think of a fictitious game in which I first meet the person who's going to be my wife, and then we jointly decide which level of investment both of us should do. That's much simpler, right? Because there is no fixed point here. This is a matching model, and the matching model is linear programming. So solving a matching model of this kind is much simpler than anything else. But what Scott told us this morning is, in principle, those models should be exactly equivalent. And then actually, this is the message of this literature. If you look at the solution of the first model in which people invest non-cooperatively, there is always an equilibrium that's efficient. And this equilibrium that's efficient is just the outcome of the matching game of the fictitious game. So at the end of the day, we're down to estimating a matching model, which is probably what we're going to do. So we could do the kind of standard matching game analysis directly on the fictitious game. I'm done. Let me just mention some direction of extension. You can put an observability in this kind of framework. If people know their ability before investing, you have a problem because people match on unobservable, which are not additive, and things are much more difficult, so there will be technical issues that we can forget about for the moment. We can introduce heterogeneous preferences for leisure. We could generalize. This is TU framework. We could be a bit more general and using ITU. There is a technical complexity, but in principle, we know how to do that. We could look at limited commitment, and in principle, we could test full commitment versus limited commitment, and so on and so forth. Let me conclude by saying one thing. This, as you see, this paper is Beckerian in many dimensions. There is one dimension in which is definitely not Beckerian. It doesn't have the kind of beautiful simplicity of Gary's model. It's not this is anything, but you know what? One thing I realized, and I realize it's more every day, is that it's bloody difficult to be simple, especially if you're not Gary Becker. Thank you very much.
I look forward to seeing the full paper when you get the results.
Me too.
My first question is, are there any other empirical estimations of a marital surplus except for the work of Chu and Xiao? First question. And second question, when you talk about the labor supply, are you modeling the labor supply of the decision maker himself or herself, or the labor supply of both the person and the potential spouse, the future spouse? Given that there are 3 periods, I assume the first period is pre-marriage, before they met their spouse. And I guess I have a third question. How do you incorporate allocation of time in the model?
Yes. Okay, so the first question, there are not that many models that try. What's surprising is that Gary wrote this paper in '73. Took us a long time to take it seriously in the sense of trying to implement it in a structural form. Now it's on the way. And actually, the paper by Chu and Xiao was the kind of first movement. And then it's not the only technology, by the way. There's been another technology developed by people like Jeremy Fox, who was here, and so on, using a slightly different approach. But now we're taking seriously those approaches. There are a few papers trying to do that, not that many, but my guess is there will be more and more. In terms of labor supply, this is a collective model, so it's a joint determination of labor supply by both spouses at the same time, reaching an efficient outcome, except that it's a very simple version of it because we are in transferable utility, so de facto it's a unitary model. So there is a utility function of the couple, and they choose the individual labor supply so as to maximize the total utility. The third one is a tough one about domestic production. I mean, I suppose that's what you have in mind, domestic production and so on. as I said, another project is to look at a model like this from a static viewpoint and trying to be serious about domestic production. And the idea here would be something like, think of a model in which the domestic production, let's think about raising children. If domestic production is cleaning up the house, it's not so easy to see why having a high level of human capital will be important. But when it comes to educating children, you can certainly accept that it's very important to have an educated wife, even if the wife stays at home, and it might not be a completely irrational behavior to marry an educated wife who's going to stay at home if the importance of the mother's education in the outcome, which would be the level of education and of well-being in general of the child, is crucial. So we have a plan, we plan to investigate exactly this. It will not be in this kind of general dynamic model just because it will be too complex. So we have started investigating this, and even in a two-stage static model, it's hard enough, but we hope to make some progresses. So someday, I might come back to U of C and this. You know, what's my natural reaction when I have ideas like this would be, what would Gary think? And the first thing I would have loved to do is come back and talk to Gary and get his input. We will have to learn to do without him, and he is a huge loss.
Is the next stage of your research going to be investment in human capital, marriage, and divorce? Because I think divorce is as important in decisions of getting human capital than the returns from marriage.
Absolutely. Yes, you're absolutely right. We have papers in which we look at of matching and divorce, but definitely not this level of complexity. Now, so the answer is ideally yes. In practice, it's extremely difficult. I mean, let me tell you what I really think on the technical point of view of this. Modeling divorce is not so much of an issue because we can observe divorce probability and we can have an estimate of welfare after divorce. What's extremely hard is modeling remarriage. Because if you want to model remarriage, you have a new matching models in which the distribution of type is endogenous to the first distribution, and this, from the technical point of view, we don't know how to address this. So ideally, we would like one kind of reduced form approach to that would be, we have prediction about the size of the surplus. You would expect that the larger the economic part of the surplus, the smaller the divorce probability should be. And this, in principle, we could test that on the data. So that would be, it's not an answer to your question, but it will be at least a step in this direction.
This general point about supermodularity comes up in a lot of different contexts. The most obvious one is teachers and students. So you think about, should you put the good teachers with the good students, or should you put the good teachers with the poorer students? It also comes up in the context of the firm. You know, you have a star trainer or a star supervisor. Should he be with the good workers, the bad workers? Now, I remember when I looked at your table, when you did the calculation, you do the diagonals versus the off diagonals, they're very close, actually. Yes. And that was true in something I estimated as well, where we were looking at workers and bosses, also very close. And yet, you tend to see very strong sorting. So the problem that you were addressing is that you get imperfect sorting. I guess my sense is that given those numbers, you almost get too much perfect sorting. And I just wanted to get your reaction to that.
Yeah, well, yeah, that's an issue. I mean, it's not completely clear because the units, I realized that the numbers are very close. Actually, I was surprised. When I received those tables, I did those computations, and you really need to write it's not that you see obviously that it is. You need to write and take care of the decimals. I'm not completely clear what the units are, so I should be a little bit careful. But I suppose it means that the fact that we have that much assortativeness in matching, despite the fact that those numbers don't seem to be outrageously different, might be interpreted in the sense that economic considerations are quite important. You know, in a world in which most of the motivation is the non-economic part, the random part, you will not see that. That would be so, which means that Gary was right. I will certainly not talk about students to professors because that's non-transferable utility. So you should ask Scott and his co-authors, but I know nothing about this. But definitely this could be applied to personal economics. So, and that maybe I should conclude on this. We apply that on the marriage market because I've been interested in household allocation and marriage market for a very long time. But in principle, the same technology could be applied on the labor market or on a bunch of different issues. We have a technology. This technology is just a development of Gary's insight. And as I said, you go back to the 73 paper. It's amazing how much there is in this paper. And we're just pushing it and doing the kind of, so Gary was opening doors, and now we're doing the kind of more pedestrian work of trying to see exactly what's behind each door. But it can be quite pleasant to do. Thank you.